Certainly coming off of what was our first quarter that ended in December, that was a very tough quarter. There was a reset that we and our home buyers were having to do, adjusting to a very different rate environment. But we did talk about the fact that in January and into February, we saw some resumption in demand, and we've been happy that that's continued through the spring.
And Allan, given what's happened in the stress on the banking system, I'm wondering, given that builders are so reliant on regional banks, perhaps not Beazer itself, but for some of the smaller builders, do you think this is going to make it difficult for them to get construction loans in the future and then squeeze pricing?
Well, it's hard to speculate about other builders. We don't have that reliant, as you point out, on the regional builders. But certainly, I think one of the things the Fed's trying to do in general is slow lending, and I think that will make credit more difficult. Certainly, the current circumstances aren't going to help that. But I'd probably be out of my lane to comment on how it'll affect other builders.
So, Allan, during the pandemic, we obviously saw a big rush for people trying to buy homes, especially away from metro areas. What changes are you seeing now that we are essentially post-pandemic?
Well, I think there's a little less enthusiasm for those communities, those subdivisions that are the furthest away from city centers, and I'm happy that we didn't chase a lot of that activity to those furthest out markets. But we're seeing demand for homes that have work from home capabilities, and that hasn't changed even as people are starting to make their way back into the office. I think most of them are hoping and planning that at least some part of their jobs are still going to be able to be done at home.
Now, you said it was kind of surprising, given that rates were bouncing higher in February, that people were still coming through the door. And we're hearing that from other builders, but we're also hearing that you're doing things like incentives and buying down the mortgage rate. Obviously, that's a little cheaper for you than actually lowering prices much more. But how much is that going to affect your margins going forward?
There's some effect, obviously, from incentives. It's interesting. We have a variety of different kinds of incentives, and we're big on letting our customers choose the program that's best for them. We're not actually seeing significant demand for rate buy downs. I mean, as I'm sure you know, the short-term buy down of rates is more comfortable from a cash flow perspective, but from a credit perspective, that borrower still has to qualify at the full rate. So we're seeing a lot of buyers take incentive dollars either to the price or for the design center, or perhaps just buy a bigger home. And so that's a part of the mix, but it's really not something that we've seen significant participation with.
One of your fellow builders, Lennar's chairman, Stuart Miller, said in their earnings report that buyers were getting used to a new normal when it came to mortgage rates. So even if we're over 6% as compared to being just around 4% a year ago, do you think buyers are really ready for this kind of new normal, given that affordability and prices are still high?
I think it's fair to say that some buyers are, but certainly as you change affordability and higher rates do change affordability, there are a portion of buyers that, as much as they might want to adjust to it, they simply can't afford it. So there is no question in my mind, at least, that it affects the size of the market somewhat. But we've got such a huge shortage of housing in this country. There are an awful lot of buyers who are in the process of adapting to higher rates. So I generally agree with what Stuart said.
So how is inflation impacting your business, not only for the commodities that you use to build houses, but also for the people buying your houses, a bigger portion of their paychecks being taken up with their household bills, whether it be food, electricity, et cetera?
Well, on the raw material or on the commodity side, we've seen significant reductions, particularly in lumber, and that's been very helpful to allow us to reduce our build costs to address this environment that we're in with higher mortgage rates. As it relates to our buyers, I think there are a couple of things going on. I mean, home buyers we are seeing are generally benefiting from higher wages, which is, I think, also helping combat some of the higher household costs that they're incurring.
But for those who aren't able to afford a home, we're seeing a lot more demand for rentals, and especially single-family rentals. And we've seen some builders get into that build-to-rent market. Is that something you like?
It's not something that we're participating in. We have sold a number of homes to rental operators, but we kind of like being a home builder, and we like the for sale business, and that's really our plan for the future.
So, Allan, there's a multi-million shortage of homes here in the United States. How much longer do you see that deficit lasting, and long term, how does that impact your business?
Well, I mean, long term, it puts a floor under demand in this country for newly built homes. We just have this structural deficit, and I don't see the mechanisms in place that are likely to close that shortage anytime soon. I mean, certainly attainability, affordability will be restrictors on our ability to serve the demand that's out there. But in terms of actually building the number of homes that we identify as being short, I just don't see that from an entitlement standpoint or from a labor supply standpoint that we're likely to make a big dent in that, at least over the next several years.